Today, an old friend, somebody that I knew from past. In If you are on social media, he's pretty vocal about his journey. Mark Kenny is out of Dallas. I've learned, Mark, you might not even know, but I've learned a lot from you as well. And today, our webinar is in a different style. Our goal is to share our combined journeys, but more specifically yours, and the lessons that you've learned throughout your investment career. Without further delay, I know my audience have they've heard from me, they've seen our team multiple times. But if you don't know, my name is Sid Shamim. I'm the owner, operator for Kismet Property Management and Headway Investments. We own apartment complexes and some other different asset classes as well. Today, my guest again is Mark Kenny, and we're going to talk about his journey, his background, and things that we can learn as an investors from some Mark. So, Mark, welcome.
Thanks for having me, Sid. Appreciate it.
Mark, I want to just quickly give you a floor. Share your background with us. What was your career before? How was your journey? How did you get into real estate? And where are you today as an owner, operator, or investor? Anything you want to share?
Sure. Yeah. No, thanks. So, as Sid mentioned, I'm out of the Dallas area, North Dallas, Frisco area, and grew up in Michigan. I have a identical twin brother, and so six siblings total. But my identical twin brother and I were, when we were in college, seniors in college. Don't really know why necessarily, but we were like, hey, we think we want to buy real estate. There wasn't anyone we knew really doing it, family members or anything like that. I'd say we both were kind of more logical. We both graduated in accounting, but we actually bought like a 3 unit property when we were 21 and renovated it and did everything. And we, at that time when we graduated, both ended up working for the Big Four, working, 70 hours a week was a light week. And
Yeah.
think of Michigan coming home. We'd leave at 7 o'clock in the morning, get home like at 10 o'clock at night and shovel snow and all those things. Right. So we're like, man, this really is horrible. Being a landlord by yourself is horrible, but continued to buy smaller properties and transitioned from the Big Four, kind of management consulting into software, worked for SAP, which Sid knows well as well, and then started my own IT company in 2008, and
Wow.
continued to buy small properties. And got married young, so I've been married 31 years.
Wow.
And my wife and I were just like we both like real estate. So you fast forward to about 2013. One of our friends was doing a syndication at the point in time, just group purchasing, right? He's bringing capital from multiple people to buy larger properties. The first deal we got into was actually a passive investment. So we invested passively. I think it was 116 doors or units. I was in the Dallas area, did a couple of deals like that, and then we started looking at syndicating. And part of it was, the IT business was pretty good overall, all
Hmm.
practical purposes. But I was, probably 80 to 100 hours a week with my IT business, like consistently, not for just once in a while, but consistently, not always sleeping much at all, and caused some issues just for relationship wise because my wife's like, okay, all you do is work, right? And so we said, let's look at doing syndications ourselves. 2015, we started looking at doing it ourselves, and we got a deal pretty quickly. It was, smaller than we really wanted. It was 64 doors. And then we just started buying deals pretty quickly. And then we started a kind of a coaching group as well, syndicating deals together with other investors. Since that time, we've done, about 18,000 units, 15
Wow.
states, and about 1.5 billion in multifamily only.
Yeah. Yeah. But I want to point out one other thing. You mentioned your first rental house was at the age of 21. You and your brother did that. And then obviously you got into in corporate world. Did you continue buying single family and rental houses until you get to the multifamily or apartment complexes, or was there a pause in between?
No, we did. We continued to buy 2 to 4 units, and then that was in Michigan. We bought maybe 6, 7 deals there, and then when we moved to the Dallas area, my wife and I bought a few single family homes, but it really never I don't think looking back then, I ever really thought of like, "Hey, this is gonna be my career." I never really
Got it.
thought that. I think I always loved real estate, but I think it was more like, "Hey, this is just kind of a side thing that can maybe be used for retirement, way down the road."
Yeah.
It wasn't really until, the stress, if you want to say relationship wise and in the work life balance, which I had no life balance really just
Yeah.
at work. And that's kind of, and then we just, decided we need to look at doing something differently.
Yeah. And that's mostly, a lot of our audience, our investors, they have the similar journey like yours and mine. I can literally relate my journey with you as well. You mentioned 2014 and onwards, 18,000 apartment units that you bought. I think, it's quite a number. Give us a little bit more journey of your apartment ownership and how did it all, came into picture.
So we started looking mostly in the Dallas area initially and bought a few deals here. And Dallas at the time we thought was getting, pretty expensive. Let's say 2000, even 17, 18. Little did we know that at least there was going to be a short run after that. But we started looking at other areas like Georgia and basically the South and then some in the Midwest. And really we just kind of connected with the brokers in different areas and we had a, good track record of closing. We did 120 deals. There's only one deal ever that we didn't close and there's some reasons why, but every deal we went under contract with, we closed. So we had a good reputation. We did a lot of value add deals. If you're not familiar with the term, I think it's misused, but let's just say we did a lot of deals that were probably considered more, I'd say more distressed. So we bought deals that were some were 0% occupied, 30, 50%. Then we bought some deals that were, 80s and 90% occupied as well. And we would, rehab them at the time, push rents, refinance. So you kind of go fast forward from when we started to about 2022. We bought a lot of deals in 2022, which I mean, this is where a lot of lessons are going to come from as far as the hard, painful, expensive lessons. Bought a lot of deals in 2022. And, we'll probably get into some of the details here, what kind of happened in the market, but, a lot of
Yeah.
things happened in the market to negative, right? And still kind of ongoing. And we were on these value add deals where we had a lot of debt that was, floating rate debt, wasn't fixed and had 2 to
Yeah.
3 year typically horizon. We got stuck. So I have, in a 2-year period, I exited about 30 deals and not all by choice. There were a few good ones in there, but a lot of those deals were from 2022 that
And you
simply,
exited those between 2022 and 2024, or it was after 2024?
no, 2024 and 2025. Yeah,
Yeah.
exited 30 deals in 2024 and 2025 combined.
Talk to us a little bit more about if you the deals that what was the percentage of the deals that, in your opinion, it's your expectation, obviously before 2022, and in terms of projections and returns, the ones that you exited on your own. Tell us a little bit more about that. What was that experience look like? And obviously, early success gave you confidence, and you gotta go full force. We'll talk about that later. Give me your experience on the deals that you sold it with your willingness because your business plan
Right.
matured, but returns hit.
Yeah. So those deals for the most part were phenomenal.
Yeah, yeah,
Because at the time, just on the market, you could, buy a deal and rehab it and push rents and refi or sell. I mean, we had, again, and we'll get into probably some of the lessons learned from the other deals, but those deals prior to 2022 had, one deal in 3 years, we made like 370% return on it.
yeah,
It's like, we've doubled our money in 14 months, doubled our money in 17 months, never lost a penny on any deals, never did capital calls from anybody. We were refinancing or selling properties on average, probably 2.5 years was our hold period, even though
wow,
we
yeah,
expected 5 to 7 years. So that was the heyday, right? And there were a lot of things working for us along with other people in the market that, no, and don't get me wrong, there's still work involved in that, right?
yeah,
Everyone wants to put it on, you're a genius if you make a lot of money and you're, kind of an idiot if you don't, right? Because it's always
yeah.
the operator. But there are a lot of things in the market that, was going for our favor. And we got into some of these markets that people just weren't in. So we went to Georgia, I think, before a lot of people did. And then a lot of people, Dallas follows there. We went to Memphis. People don't like Memphis, but we've done really well there. And, people
Back
started
in the
to,
day, I mean, it's just
yeah,
old. Yeah,
yeah, people started following, going there, and then
yeah,
Arkansas and things like that. So we kind of got a little head start on some of these markets, and then we sold people that were trying to come in the markets and,
yeah.
that time ridiculous pricing.
And all of those deals, you were not self-managing. You were using a third-party management.
That's correct. And I look back at one of the lessons learned. I would going back to it based on how much volume we had. We should have self managed.
And those three guys who are new to apartment investment or real estate in general, the time that me and Mark are discussing is between 2014 all the way to 2021. call it 2022 COVID, before COVID time. And Mark is absolutely right. I mean, those deals, those times, can buy a deal and do nothing, and you still sell for profit. Right?
Right.
You don't have to do any of the innovation. So there's just buyers out there who are just looking for the deals. Mark, tell us a little bit more about people who, in a layman language, what happened in 2021, 2022 in terms of the economy, the rate hike, and what conspired those external factors to pretty much everybody, to you and to most of other operators. I want my investors, our audience, to understand, in simple words, what are the external factors were there, interest rates and
Sure.
all of those things in 2022 that brought
Right.
us here.
Yeah. So starting 2022, a lot of people would say, hey, what's the one thing? The one thing that caused everything? Well, there isn't really one thing that caused everything, but, a couple, real stats, right? So there were 11 rate hikes in a row, right? Pretty much never happened before. Real value debt, we might have been having debt at like 4.5% interest rate when we bought a deal that literally went to like 11, 12% interest.
Yeah.
Nobody can operate their way out of that. Now you can say there are certain things, not to be confused with cap rate, but there's something just called a rate cap, just call it interest rate cap. Just think of it as a insurance hedge protection against how high the rate can go up.
Yeah.
We had that on a number of deals, some we didn't, but even the deals you had it on, most of these loans were short term, usually 2 to 3 years. I mean, they could be a little bit longer, but generally speaking, 2 to 3 year loans. And when, the economy started going south for a lot of reasons, the interest rates and other things I'll talk about in a second here too, you started going say, well, now the lender says you need to do a new rate cap for that interest rate protection. And if you look at it, what it was when we were buying deals, and this is a big number, but a $100 million loan, it only costs about $98,000 for that protection.
Yes.
And everyone's like, why would they even do it? Like it's,
Yeah.
rates are going to go down. That same protection that cost $98,000, fast forward 18 months, was $3.4 million. Meaning 2 year, you go into 2 years, the lender's like, well, go do a new rate cap. You're like, wow, I need to bring another $3.3 million. And then to make matters worse, they said, well, not only that, we, the lender, are going to rebalance your loan too, because we don't think it's worth as much. And we want you to bring another $5 million to the deal.
Yeah.
This is what was happening. That on top of like we all know inflation and labor costs and materials, insurance, depending on where you bought in, location going to be critical. We bought in 15 states, and the markets that are more coastal, you're just going to have those insurance rate hikes in Florida. While we bought a lot of deals in 2022, fast forward to 2023, the insurance is going up 2 to 300% in a
Yeah.
single year. And that's a
Yeah.
big number. And you have property taxes going up. And in fact, we had one property in South Texas that it's a larger property, but the insurance when we bought the property was $600,000 a year. We tried to renew 1 year later, it was $3.6 million.
Yeah. Yeah. In the
Right.
Corpus Christi area.
So 600% increase.
Yeah.
So you say, okay, well, and then you had the other issues, and in some, even after COVID, it got a little bit better, like with evictions and things like that. And then some parts of the country got even worse. So
Yeah.
even in 2024 and even parts of 2025, it was still taking us like, 16 months to evict tenants.
Yep.
Well, you're sitting there going, well, that's going through the roof. My payment's going up 2, 3 times as much. My insurance is going up. My labor costs going up. Our rents are our rents are stable or going down pretty much across the entire country. And you're stuck. Now you're at a point where your timeline for your loan comes due 2 years later, where it might be in the market. So if you look at, Jacksonville from 2022 to 2024, values went down 41%. So cap rates went from 4.4 to 7.5% in a 2 year period,
Yep.
which means you can't even sell your property for enough to pay your lender.
Yep.
So what do you do? Right. So those are a lot of the factors, and people are like, why would everyone why don't you just go get fixed rate debt? Right. Why from the start? Well, reality is most of these deals wouldn't qualify for like a
Mm.
Fannie Freddie loan. You typically have to be 90% occupied or higher for 90 days or more. They weren't given really any capex dollars. If they were, it was maybe, two to $5,000 a unit. And some of these properties were, $20,000, $30,000 a unit rehab. And you have a bridge lender saying, I'll give you a loan for 75, 80% leverage, plus give you all your
Yeah.
capex. And you're
Yeah.
like, this
Your
is great. I'm getting
your
like
down payment goes
85%
down. Yeah.
leverage.
Yeah.
It's
No,
great. Yeah.
this is awesome, Mark. I think you um, loaded a lot of information, and I want to just kind of simplify for our audience who are not used to all of those terms. But really, what you're saying is, and what we all experience after 2022, all those loans, the floating interest rate debt, meaning your interest rate not going to stay fixed. A lot of those type of loans were out there in the market, and that was the only way to get to buy commercial real estate. And the insurance on those floating interest rate was very cheap. Meaning, guys like you and me and all of our operators, we knew, or at least we knew at the time, that because the insurance on those interest rate is so cheap, more than likely they're not going to go up.
Right.
And that is the whole premises, right? So a lot of people bought those apartment complexes that need renovation and capital expenditure. And Fannie and Freddie were maxed out by giving those loans. So a lot of times, actually 99% of the time, they're not doing more loans because their balance sheet was full up until 2022, 2023. Just to simplify what Mark said, right? I'm not really adding anything. I mean, he was very descriptive about it. The interest rate insurance was cheap. The floating rate or the variable interest rate loans were very common. A lot of people did that. Some of us bought the insurance for more years in case if the interest rate goes up. And it saved some people and it did not save a lot of people. But Mark, you also mentioned the operating cost of running those businesses went up, meaning
Right.
insurances, COVID, because of the COVID, the
Utilities.
utilities, the insurance, the property taxes, and general R&M cost. Right, your paint is expensive, your material is expensive, your light fixtures is expensive. That's to me, that's a perfect doomsday. Right, people don't talk about it. It was not really a recession, but if you are talking to an operator who is trying to run a commercial property, your debt is distressed, meaning your loan is not helping, and your operating costs are not helping. And then on top of it, we have not even talked about the challenges about the third party management company and the employment or hiring a good employee and retaining a good employee for the cost. The payroll went up. Those are just cherry on top, right? That just give us overall. So in summary, I just want to make sure I'm repeating this for to myself to dumb it down. 2022 to 2024 was a perfect storm, right? When it comes to commercial real estate. Tell us a little bit more about what other factors that contributed. Lenders were coming back, say, "Hey, interest rate went up. Now you have to bring us more money to the table." Meaning, your down payment that you thought you're gonna put was not true anymore. Lender was saying, "Give me more money, otherwise I'll take care of it. Otherwise, I'll take your property back." Not a good sound at all. Tell us a little bit more other factors. I mean, we talked about lenders, rates, operating expenses went up. Tell us a little bit more about people problem, partnership problems, whatever that could be. Right? I mean, we talked about the good part. Now we're
Right.
going deep into the ugly part.
Yeah, the property management you mentioned, and I'll just briefly say, we've used at one point in time, we had 27 different property management companies that we used across our portfolio, meaning these are third party, supposedly, very good, recognized, manage thousands and thousands of units. And I can tell you for whatever reason, most of them are not very good at all. They're mostly, geared towards revenue, right? They're compensated based on revenue. They're not really compensated based on controlling expenses. And I'm not saying they're all bad, but it's a very the turnover rate is horrible, especially in some markets. You might in properties, you might have three, four different property managers in a year. So you're always just kind of contending with that. A lot of them get very little guidance to no guidance from the corporate office. So they don't even know what they're doing. You ask basic questions or suggest things, and they're like, you're like, how do they not already know this? But they don't. So, that's kind of more on the manager side. Partnership wise, I mean, we could easily do a whole, webinar just on partnerships. I've done a lot, I've seen a lot. Yeah. And there are, a couple of things in partnerships where you want to be very careful about. Let's say Sid and I want to go create a LLC together, and we do. And then, I go off and do something, right? And Sid has no idea what I'm doing. I go sign a contract. This happened to me in 2016. Partner signed a contract. They also call it PSA, purchase sales agreement, but
Mhm.
it's a contract to buy property. I was not aware of it, didn't support it. My partner couldn't perform, couldn't put the earnest money in. I wasn't going to help him because I thought the deal was a piece of junk. And we got sued, and I'm sitting to myself, I'm almost like, "This is comical. We're getting sued over this. What is it? What are you talking about?"
Because he used your LLC.
Yeah,
He
he
used
used
the
the
LLC
LLC to
to
do it,
okay.
and I was part of that. So we got sued. I mean, that thing, in addition to attorney fees, cost me $371,000 personally out of pocket just to make it go away. You have other, partnership just issues where, and this is a real story where a partner of mine that I was a partner for 10 years. I don't know if you want to call it forged. He drew a straight line from my signature, but forged my signature, sold the property without my knowledge. So there are a lot of things around partners. And the reality is, when I hear people say, well, I really trust this person. Well, on paper, you need to assume you can't trust anybody at all. Assume they're going to do everything wrong. Make sure you account for it. I've seen so many contracts and agreements and partnerships now where things are vague. I have a good friend of mine has a multi-million dollar business. He was in partner with, not real estate, partnership with his brother-in-law. They got into, disagreement.
Yeah.
His brother-in-law was bought out, and now my friend's wife hasn't talked to her sister in over 2 years, right? This is, like, real.
Yeah.
We have partners that we partnered with that are, you can't, nowhere to be found. Won't return text messages, emails, phone messages. The thing about partnering with somebody is that you sign a loan doc together. Sid and I sign a loan doc together. There's something called joint and several. That means we are both 100% accountable, no matter what. Even if Sid didn't even know what I did, I could have been fraudulent and did all these bad things. And Sid's like, I didn't know that. I didn't participate. Oh, it doesn't matter. Here you go. We're suing you, Sid, for the full loan amount of, $20 million. So when I hear people, a couple things. One, where I hear that, oh, I really trust this person to invest with them. Well, most people trust the person they're marrying, and over half of those end up in divorce. So why would you think that maybe you do enough partnerships? Why would you think you're never gonna have a problem in partnerships? So nothing can be vague. Nothing can be like open for interpretation of who can do what, or
Yeah.
what terms like what we think is reasonable. That's bad. Doesn't define anything. It's not quantified. And then you just have, the other investors too, like 1031 investors, if you want to call them partners. That's a whole kind of different angle, whether you're a syndicator or a 1031.
Yeah.
Some people don't know if you're a 1031 investor. One, you might come into a syndication and have little to no control, just depends how it's structured.
Yeah.
And there's a strong likelihood that you're going to have to sign on a loan as a guarantor. Most of those are non-recourse, but that's somewhat just means you don't have personal liability, but that's not true. There are other things that can trigger, real or made up. Lenders have a good way of making things up, which they do. But that's what these bridge lenders, some of them are out there being, I would consider bad actors. That's whatever you want to call them. Fannie and Freddie, the fixed rate environment and stuff like that, where the deals are a little better. You're not going to usually have as many issues on those type of loans. But some of these bridge lenders, they're horrible. They're operators too, meaning they'll more than gladly
They
take the
lend they
property,
lend to own. They lend to own.
lend to own. And one guy kind of challenged me on this on LinkedIn. I know the guy, and he's like, I was a lender and I'm a debt structure guy, but I think you're being a little like generic here. I'm like, no, I don't want to do business with lenders, the operator. And not to be whatever, this guy hasn't signed us. I know the guy hasn't signed probably a guarantor on a single loan.
Yeah.
So I've
How
done
you know
120. So
exactly.
if you want to come talk to me about real experiences versus La La Land,
Yeah.
I'm here to tell you that I've been on calls directly with lenders that have flat out said on the call, we're operators. We'll just foreclose on the property. We don't want to work with you.
Correct.
And we've had the reverse where lenders have said, we're not operators. We want to come to some sort of solution on this. We're happy to work with you. Let's see if we can come to some sort of arrangements. All things being equal, why would you pick a lender that's an operator? I wouldn't. And also if they sell the loan off. I mean,
Yeah.
these bridge lenders sell the loan off. If they do that, then usually after 60 days, even if that lender wanted to work with you and really be nice, and they're usually limited and they can't even work with you. So your debt structure is so critical, and not to just throw one other thing in there around, the fixed long-term Fannie Freddie loan, things like that. When people are like, well, that's an obvious choice, just do that. Well, you can't neglect what the prepayment penalties could be down the road. And you have some options that are known. I know it's a 5% prepayment penalty goes down to 4%, 3, 2, 1. That's a known.
Mhm.
Or you have, terms, don't get too hung up on them, and yield maintenance, defeasance. And just to put it in perspective, we had an $8.2 million Fannie loan. This is probably in 2022, I believe. And we were selling the property. So $8.2 million loan. Our prepayment penalty was $2.4 million. That's real money off the
Yeah.
so people when people argue like, oh well, why would anyone do bridge loans? And well, we personally on bridge loans, by doing bridge loans and not having a fixed debt, probably have saved, $50 million, if
Yeah.
you want to say. Now, we've also, don't get me wrong, we've had the reverse and got caught on those bridge loans too during the, 2023, 2024, 2025 actually too, right? Mostly 2024 and 25s for us. 2023 was pretty light. Really weren't a lot, issues were surfacing, but that's not really where a lot of the issues really
Yeah.
surface.
I just wanna point out you definitely covered pretty much everything. So what you really what we're really talking about here is there are really three kind of partners. One is your operating partner, the guy who's going to work with you, pick up phone calls, maybe raise capital, maybe do asset management work, talk to third party management companies, negotiate a contract and things of that nature. And then your second partner is your debt partner, which is your lender.
Right.
If your lender is bad, if he's a bad actor, then it's a problem. And the third is really your investors who are trying to invest with you. The examples you mentioned about some of the partners did wrongdoing with in certain cases with you is the one who are your operating partner that you built an
Correct.
entity and LLC with. Obviously, people can sue anybody and everybody. My question to you in this part on the partner number one, which is your operating partner, what are the top two or three things that you will not do? Or can you advise? Hey, stay away from this. If you really want a partner, should you really take a partner or not? Or
Yeah.
if you have to have a partner, what are the things that you would say not to do?
One, I would never have a 50-50 partnership from a decision making standpoint. Now, Sid and I could both be 50-50 partners, but if we can't agree on something, we need to have a tiebreaker that's written into the agreement. Not like, hey, we just talked about it, written into the agreement on paper. And if Sid wants to do something and I don't like it, and we go to the mediator, if you want to call them, and they say, well, they agree with Sid, then it's like, too bad, so sad, Mark. You have to suck it up. You don't have anything to whine about, right? I'd say 85, 90% of the partnerships I've seen are 50-50 partners. So don't do that.
Yeah.
The other thing in there, both partners need to decide on things. I've seen partnership agreements where one partner can decide to do something. Now, the fact where my partner sold this deal, he was not allowed to do that without my
Sure.
consent. He did
Yeah.
it anyways. So if people want to do some fraudulent, shady crap, if you want to say, they're going to do it.
They'll do it. Yeah.
And you have things in there where a partnership agreement, if you're going to have one, I would say make sure it's defined. When you say, hey, major decisions can be made by a manager. Well, what's a major decision? I mean, is that a refinance, a sale, new capital? Everything's going to be completely split out. What and who can do what. That's very important. And then, without getting into all the legal aspects of it, do you have, when you're transacting on a deal, putting under contract, what is that LLC? Is it a holding LLC? Does it have any assets? Does it not have any assets? And then we see people that are, I might talk to them on a regular basis. They're buying multiple properties, usually smaller, right? But they have like
Yeah.
one LLC for all the properties, or worse, it's in their name. And if something
Yeah.
happens at one property and you get sued,
Yeah.
then the other properties are at stake. Now, in the commercial real estate, generally speaking, your lender is going to
Lender wants that. Yeah.
and
Sure.
help you not make that silly mistake, if you want to say. But you don't realize these things until you run into it. You think, well, one, you might not know about it. Two, you might know about it and say, well, I don't think it's ever going to happen. Well, these things do happen. So I would say, no 50-50 partners, make sure everything is defined. Well, everything should assume everything's going wrong horribly. And then just from a structure standpoint, what is your LLC structure as far as transaction based when I go under contract on a deal versus when I'm operating a deal or operating my business?
Yeah. This is perfect, right? I mean, you're listening to two kind of people. Mark have done partnerships. I have not done any operating partnerships. And and again, I want to be clear, this operating partnership is one that we're talking about, that somebody who is a co-GP or a co-partner of that sort. So my learning or my experience is similar to, well, I've learned it from a distance, that if we go do that, the ship sucks, right? Unless and until, you're vigilant enough and you spell out everything, again, you will still miss a lot of other things that may not be covered in the operating agreement, unless and until you hire a qualified attorney and he's covering all of those things. Well, that partnership building might take you a year to come to an agreement with somebody. So two different perspective, right? If you want to do it, that's what Mark says. You cannot have two heads to make decisions. You cannot have anything not written in your operating agreement that comes with combined back here. And the third you mentioned, Mark, is the structure of that partnership. The partner that you're bringing in, you got to know what they have, their liability or their baggage coming up with that, right? These are difficult tasks, right? I mean,
Yeah.
not many people can do that, right?
The
So
one thing I would say, just to
yeah,
pick up on the two heads making decisions, it's fine with two heads making a decision provided they agree. It's really more when there's a disagreement, who will be the tiebreaker. That's where you run into the issues. If everyone disagrees, hey, we should sell, we should sell, we should refinance. Then you could have both managers. I mean, in every case, having one manager just make a decision to sell. And now I would say if that the manager is also the guarantor on the loan and the other one's not, then I think the one who signed their name on the loan should have more
the
clout.
one making decisions. Yeah, absolutely. And then if the two managers making the same decision, then really you really need one if that's the case. Tell us top two lesson learned, so top three lesson learned when it comes to working with lenders. Obviously, you said beware of the lenders who are also operators, meaning and people who are new to this concept. You're if you're buying a house, and I always take this example, if you're buying a house and your lender also try to flip houses, they take an example, you miss a payment, they're coming and getting your house. They're not working with you. They're not giving any. So obviously, you mentioned one of those. Give me two more. What are top two?
The one I mentioned briefly was the balance sheet. If they keep their loan,
Sure.
lender keeps it on their own balance sheet, they have a
Yep.
lot of control of what they can do to help you.
Yeah.
If they sell their loans off, then they have very limited, in some cases, after a period of time, usually 60 days, they have no control
Yeah.
over how much they can help you. The other one would be, so if you think of, you go buy a house, it's recourse debt. Like there's no question you're on the hook if you can't pay, right? I mean, the lender can come after you personally, and depending where you live, your house could be protected, but a lot of other things are not protected. They come after your personal assets. On a commercial loan that might be a non-recourse, you want to know, like applies to any lender, but you want to know as far as what is the bad boy carve out. What are those clauses in there? All that means is, if you think of the obvious stuff, the lender would say, well, hey, this is non-recourse. We cannot come after you personally. Even if you fail, you don't pay us, we take the property back. But if you trigger one of these bad boy carve outs, and an example would be if you get a lien on the property. Okay. Well, that's a limited bad boy carve out. I mean, I have a property, have a $70,000 lien on it. If the lender tried to come after me, for that, for whatever reason, then it's limited to 70,000. You have other things like, hey, I committed fraud, I lied, I cheated, I stole. That's what's considered a full recourse. So the lender doesn't even have to have damages. They can sue you if your loan is $20 million and the lender says, well, hey, Mark, you actually committed fraud. We're taking the property. We own the property. We sold it for even more than what our loan is. We're still suing you, Mark, for $20 million because you committed fraud. That's a full recourse. But the thing is, people think of those big things. There are ridiculous, and I mean ridiculous examples. I have one personal where we financed our insurance in 2023 like you would your home insurance or car insurance or like that, because we were strapped for cash on the property. 2023, the lender paid it, no problem. 2024, the lender says, oh, you can't do this. The insurance never lapsed. It was the coverage that was required. It was fully paid through the insurance company, and lender says, we're going to sue you for $14.9 million for full recourse because you finance your insurance, subordinate debt. It's made up. It's bogus. It's silly. But these lenders will make up whatever they want. They'll make up terms like, oh, this is waste. Most people have never heard of that. Waste really means you abandon the property. Well, that's not really what happens in most of these cases, right? So I would say, like you said, the operator piece of it, not being an operator, and then the other things would be more around the control. So if the lender says, "Well, hey, we're going to put it in lockbox," so lockboxes, think of, it's an account that gets set up. All rents go there. You, as the owner, don't get any money until after the lender pays the mortgage, escrows, and things like that. Then they say, "Oh, there's no money left over." Sorry, Sid, you have no money, right? So that's thing. But just more the structure of the loan. There are a lot of things which can't go into a lot of detail just because terms might be confusing too. But you need to understand things like interest reserves and how those work. And is there like a floor? Meaning we have money right now sitting there with lenders we can't touch. Lenders sitting there is collecting interest on it. We can't touch it.
They're earning those interests.
If we touch it, then it triggers, we have to replenish something. So we can use it, go below 2 months, and we have to replenish it to 4 months. So just like silly things like that. Their draw request, understanding how the lenders do their draw request for like reimbursement for CapEx, things like that. In some cases, you might have it where you can only do it every 3 months. Some
Yeah.
cases you might have it where you have to have a minimum. You can't even submit a draw request less the minimum of like $100,000. So the structure of the loan, like we have the obvious things like interest rates and term and things like that. If you have a loan that's like, a 311, which is like a 3-year loan with two 1-year extensions, you have to assume that it's a 3-year loan. The lender's not required to extend it. So and I think the last thing would be if you're looking to do a loan, ask around and see what people's experience has been with a particular lender or lenders. There's some I would never do business with again ever, no matter what.
Yeah, we all have that.
Yeah. And there's some that are good. Even though things didn't work out on some of the deals with these lenders, they're still good lenders.
Yeah. Yeah. So you really, what you're saying is obviously lenders who are operators, be careful. Also, really understanding the recourse factor of it. And people who are not familiar about this term, recourse meaning you are responsible if anything goes wrong with the property. Non recourse means you're personally not responsible. Your property will be responsible to pay back whatever that worth at that time. And then what really Mark was saying is knowing exactly the details of those recourse could be, you know, cases where there's very little
Yeah.
versus big, right? Fraud versus
Right.
missing a $500 lien payment, right?
Yeah.
You have every business have several vendors, and some vendors are stupid. They send you invoice, may not have received, they may not have seen the contract. Long story short, that $500, $300 lien on your property can trigger the recourse. And it's as crazy as it sounds, that happens all the time.
And just to make one quick comment on that, because I know we are going a lot of detail, but the Sid could have a deal. I'm a vendor. He owes me money. The property owes money, right? I send in, some sort of default notification to the address, like that's
Yeah.
his home address. Okay. And he moved. He never got it.
Yep.
I actually, as a vendor, can literally potentially foreclose on his property if
Mhm.
he owes me $1. Now there's some redemption rights, things like that. So if you're going to get into business in any way, with an LLC, you want to use what's called a registered agent, and that's where all legal and tax notifications will go. Because Sid and I could be partners. I go move away, or something happens to me, and everything is going to my address, or even in my PO box or whatever. Sid never gets notified. And now he's stuck. This has happened. Like this happens all the time. In fact, I posted something from 2 weeks
Yeah.
ago. A guy called me in Alabama. His property got foreclosed on without his knowledge. And this is legit. So making sure your structure is correct, but also making sure you're notified of every single, bad thing happening on the property.
Yeah, yeah, yeah. This is all valuable information, Mark. We are coming close to our our 1 hour mark. We can talk all day long, dude. I think we have not covered all the partnership structure that we need to have in place with our partner. The one thing we know, um, if you are an active investor or a passive investor, meaning if you're trying to be a general partner or limited partner, and if you don't care about all of these terms, if you are somebody who wants to invest in real estate and you're trying to decide whether you want to do it on your own or you want to do it with established operator, this last 45-minute conversation will tell you how important it is to work with experienced people. Obviously, um, most of the operators in the market right now have good days and bad days, and definitely those last 4 or 5 years have
Right.
not been good days. We have not been able to touch. I think we have to bring you back in our monthly webinar as well. We have not able to touch what are the things that we should be looking at when we are doing our own self management and third party management. By the way, we manage our property ourselves. We are corporate heavy, on site, easy. That's
Okay.
our model, and we audit everything. Again, it's not by choice, but it's by how the business needs to be run. We
Right.
audit our move outs from the corporate. We audit our bad debt collections from the corporate. We audit our water bills. We read our meters every day to make sure that there's no spike, and then we do. That's a whole universe on how to keep the operations in check. And the reason I say that is because in a downturn like this, when your loan is not helping, your lender is not helping, your inflation is not helping, which is external environment. The really one thing that left with is how, again, like you mentioned, who you are picking as your partners and what kind of details you're going into. That's number one. And number two is really your operations. Right?
Right.
We have had deals where we were in the floating debt, and if that would be the case where we didn't have the operation in line, we would have lost those deals.
Right.
If we had the operational line, that's the only reason we were able to get out of the floating rate interest rate loans to a fixed loans. But again, you and I both can possibly agree that 2026 is no different than last few years. It's probably the same. So, Mark, thanks a lot. Any final comments? Like I said, dude, we can talk all day long. Operations remaining, capital raising is another topic, and I know you have your website. Please tell our audience if they want to learn more. You have a really awesome 10 lessons learned PDF that you have. Where can they go? How can they connect with you? LinkedIn, website, phone number, whatever.
And just connect if you want. There's a form on thinkmultifamily.com. I mean, I've done a lot, focused on the distress part. We actually just finished a distress course. We're going to be doing an event at the end of May for the first time ever around this topic, all around distress, but also we've been fairly negative on this call, right? As far as things that went wrong, but there are a lot of things
Oh
that
yeah,
look positive as far as lenders are starting to discount deals. There are cash and refi opportunities to come in as new investment, things like that. There are less competition from syndicators and all those things. But and then like you said, I have the 10 lessons learned. I have a book that's coming out too. And this is not a book to be like, look at me, how great I am. It's like, hey, I got my butt kicked, and it's
yeah, yeah.
200
It's
page.
most value than reading
It's
a nice.
50 critical lessons that I learned during the downturn, and you might say, well, hey, what if I get into it? There's not a downturn. Well, this is going to help you prevent, you from making mistakes. That these aren't $10,000, $20,000 mistakes. These are hundreds of thousands and millions of dollars of mistakes that can be prevented.
Absolutely. Well, Mark, thanks a lot. Those of you who wants to connect with Mark, he's very active in LinkedIn. Mark Kenny, you can look for him and ask any questions. Mark, we gotta come back again, probably sometime
Sure.
this year, and we're gonna talk about more good stuff, right? Like you said,
For sure. Yeah.
we touched a little bit on the good part,
Yeah.
but the topic today was good, bad, and ugly. Unfortunately, we were bad and ugly that we're just talking about.
Yeah.
We want to talk about good as well. The time didn't allow. So thanks, Mark, for your time. And look, I personally love the fact that you're open about all of these learnings, and it shows your mindset, your mentality. You're sharing your experience. People who don't even know you, right? And that going to hopefully save a lot of mistakes from other people and a lot of hard earned investment and money. So I personally admire this a lot. That's one of the reason I told my teams like, man, we got to bring him on our monthly webinar. So thanks for doing that.
Thank you, Sid.
Appreciate it. Thank you guys.